Welcome back to The Explainer, everyone. Today, we are unpacking an absolute massive contradiction at the very heart of the pharmaceutical world. We're looking at a company that possesses some of the most enviable financial metrics on the planet, yet its stock chart, it literally looks like a roller coaster in freefall. We're tearing down Novo Nordisk, the Danish pharma giant behind absolute household names like Ozempic and Wegovy. We are going to strictly follow the data today to find the red and green flags the mainstream financial press so often just totally misses.
So here is the billion-dollar question. 60% return on equity, trading at just 11 times earnings, but suffering a massive 67% drop. Is this the ultimate Warren Buffett dream scenario, a wonderful company at a fair price? Or is this just a classic value trap waiting to snare overly optimistic investors? Well, to figure this out, we have to look really closely at the extreme data points driving this entire paradox.
Notice this single staggering number, 60%. Just let that sink in for a second. That is Novo Nordisk's return on equity. To put that into perspective, Warren Buffett typically looks for an ROE of around 15%. But Novo? Their historical ROE has consistently exceeded 60 to 80% in recent years. Basically, this means the company turns every dollar of shareholder equity into nearly 60 cents of annual profit. On paper, that is a world-class, honestly almost unheard-of level of profitability that immediately grabs any serious investor's attention. But then comes the devastating drop, minus 67%. The stock has absolutely plummeted from its 2024 peak of over $130 all the way down to roughly $44.53. Honestly, there's a pretty brutal irony in a weight loss company shedding two-thirds of its own market cap so quickly. How does a company with world-class profitability lose that much value? What is the market seeing that isn't immediately obvious on a basic balance sheet? That's exactly the mystery we're solving today.
To really understand the risks, we first have to grasp their sheer scale. Novo Nordisk commands roughly 30% of the massive $100 billion global diabetes market, right alongside half of the $15 billion insulin market. Their flagship GLP-1 products, that revolutionary class of diabetes and weight loss drugs like Ozempic and Wegovy, have driven such explosive growth that they briefly made Novo Europe's most valuable company in 2024. But as we all know, dominance today does not guarantee dominance tomorrow.
Section 1. The hidden red flags. Let's get into it.
Let's systematically unpack the bear case here, starting with the single biggest risk on the board, the pipeline crisis. Semaglutide, which is the active ingredient in both Ozempic and Wegovy, loses patent protection by early next decade. That's a ticking clock. And without new blockbusters ready to go, revenues could be absolutely devastated. And their pipeline? It's struggling right now. CagriSema, their next-generation obesity drug, failed to match Eli Lilly on blood sugar control, missing its second primary endpoint. Ziltivekimab completely failed a late-stage cardiovascular trial. And Monlunabant, an oral obesity drug, triggered a massive 4 billion Danish krone impairment charge. So yeah, they are facing a major patent cliff without a clear successor in sight.
And listen to this quote from CEO Mike Dustadar, which really reveals the internal pressure regarding these setbacks. He states they need more shots at goal and must learn from the failures. Now look, transparency is great, but when a CEO is actively telling the market they are in a phase of learning from failures regarding their flagship pipeline, that is absolutely not a vote of confidence for investors who are looking for predictable, stable future earnings. The thing is, the problems aren't just far off in the future. They are happening right now. Operational deterioration is accelerating. Their 2026 adjusted profit is projected to be totally flat, maybe even down to negative 6%. And even more alarmingly, U.S. sales are actually declining. The U.S. is the world's largest pharma market, right? It's the primary battleground for GLP-1 dominance. If they are losing ground there, while competitors like Eli Lilly are surging ahead, the long-term growth story is fundamentally broken. Furthermore, Q2 net profit declined 21%, and analysts noted that their Q2 earnings beat was pretty much artificially boosted by rebate adjustments and temporary factors, completely hiding the underlying weakness.
Let's wrap up these red flags with the hard financial reality. The Graham number, which is a classic measure of defensive intrinsic value, sits at roughly $25.31. With the price hovering around $44, it is trading way above its conservative value. Then, you add in a dangerously high PEG ratio of 3.08. For context, that is triple Peter Lynch's threshold, meaning the stock is priced for high growth that honestly just may not materialize. Combine all that with a current ratio below 1.0, indicating very tight short-term liquidity, and it is no wonder analysts from Citi to Jefferies are completely unimpressed by recent results.
Section 2. The spectacular green flags.
Okay, take a breath. It is time to pivot sharply to the positive data, because honestly, the green flags here are equally spectacular. Novo's returns completely dwarf exceptional benchmarks. We already mentioned the 60% return on equity, but notice their return on invested capital. It's sitting at an incredible 32.2%. ROIC simply measures how efficiently a company uses its cash to generate profits, and both of these metrics completely shatter the standard 15% threshold sought by legendary investors. I mean, this company is generating absolutely massive value.
And while the pipeline definitely has some holes, their current innovations are still completely dominating. Despite missing some overall sales expectations, the new oral Wegovy pill has captured an astounding 90% of the oral obesity market. The CEO even confirmed this pill is highly profitable and is directly contributing to positive growth. This represents a massive competitive advantage as the market starts shifting toward new, easier drug delivery formats, moving beyond just traditional injections.
Make no mistake, this business is a fortress. Guru Focus assigns Novo a moat score of 9 out of 10. This moat is built on over 85 years of leadership, incredible brand power, and importantly, controlling roughly 50% of the entire global insulin market. That dominance generates unbelievable cash. We're talking $132.9 billion in trailing 12-month operating cash flow. That is an enormous amount of firepower they can deploy for strategic acquisitions or just accelerating R&D to fix their pipeline crisis.
Finishing up the green flags, we see incredible stability. Their leverage is exceptionally low, with debt relative to their earnings well below conservative limits. They offer a super solid dividend yield of roughly 3%, with a very manageable payout ratio given their sheer profitability. Plus, they're actively rewarding current holders by continuously shrinking their share count by about 0.8% per year. So, from a pure balance sheet perspective, it's a financial rock.
Section 3. The ultimate investor face-off.
So, with a mountain of severe red flags on one side and spectacular green flags on the other, who would actually buy this stock? Let's run Novo through 3 legendary investing frameworks. First up, Benjamin Graham. While the PE is under 15, the price to book is way too high at 5.75, and the price is well above his Graham number. Graham's verdict? A hard pass. It's just too overvalued for him. Next, Peter Lynch. Now, he loves simple businesses, but that PEG ratio of 3.08 is a total deal breaker for him, especially with declining revenue growth projections. Lynch's verdict? Also a hard pass. Finally, Warren Buffett. Now, this is interesting. Novo passes his ROE, ROIC, margin, leverage, and moat tests, scoring a solid 7 out of 9. But it fails on the low owner earnings yield and that massive pipeline uncertainty. So, Buffett's verdict? A partial fit. He'd absolutely love the business quality, but even Buffett's famously strict standards would likely make him wait for a much better entry price or for that pipeline to stabilize.
Section 4. The final verdict. And that brings us to the culmination of our analysis today. Look, Novo Nordisk is pretty much the ultimate example of a quality business at a questionable price. On one side of the scale, you have absolute world-class quality, an exceptional moat, and totally market-dominating profitability. But on the other side, you have existential risks, the looming patent cliff for semaglutide, very real pipeline failures, and a low 2.2% owner earnings yield. This is definitely not a stock for conservative value investors. It is a high-quality, high-uncertainty asset suited really only for those who have deep conviction in Novo's ability to buy or build their way out of their pipeline crisis, and who have the risk tolerance to withstand some major volatility along the way. Which leaves us with this final provocative thought. The stock has crashed 67%, bringing its PE down to just 11. So what do you think? Is this a dangerous value trap waiting to catch investors who are ignoring the incoming patent cliff and shrinking U.S. sales? Or is this a rare moment of temporary distress, literally a generational opportunity to buy one of the most profitable, wide moat companies on Earth at a massive discount? The data presents the paradox. Now the decision is entirely yours. Take these insights, continue your research, and determine if this pharmaceutical giant actually fits your strategy. Thank you so much for joining me on this explainer. Keep learning and stay sharp.